Hey there, and welcome to the Deep Dive.
Great to have you with us.
Get ready, because today we're diving deep into a situation that's really making waves, especially in tech and finance. We're talking about Wolfspeed.
Yeah, Wolfspeed, a major U.S. player in, that critical silicon carbide technology space.
And frankly, the news lately, it's looking pretty grim. There are some serious reports flying around about financial distress, even potential bankruptcy.
That's right. We've waded through a stack of detailed reports, research notes, trying to piece together what's really going on.
Complex, definitely.
For sure. We're looking at their finances, the very real risk of bankruptcy, and what options, if any, they might have left to, try and steer clear of that.
So our mission for you today is basically this.
Yeah.
Cut through all the noise, understand the core issues, and give you a clear, concise picture of what's happening with Wolfspeed.
Who the key players are, what the stakes are.
Exactly, and why this whole thing matters, not just for Wolfspeed, but potentially for the wider tech scene.
It's quite a story. We'll break it down.
Okay, let's jump right in. The first thing that just screams out from the sources is the financial situation.
Yeah.
It's precarious, like looking at an absolute mountain of debt.
It really is. The numbers are pretty stark. You're looking at total debt around $6.29 billion.
Billion, wow.
Yeah. And most of that, think over $6.28 billion, is long-term debt. Even after you account for their cash, the net debt is still huge, like $5.25 billion.
And their balance sheet, looking at the end of March 2025, it just feels incredibly tight. They had about $1.3 billion in cash.
Right, $1.3 billion. Sounds like a decent chunk on its own.
But then you see the other side.
Exactly. Total liability, $7.36 billion. And total assets are only slightly higher at $7.57 billion.
So that leaves shareholders' equity, what, almost nothing?
Paper thin. We're talking around $210 million. Just a tiny cushion.
And that thin equity, that must show up in the ratios.
Oh, absolutely. The debt-to-equity ratios tell the story. Annually, it's already high, like 7.13. But the quarterly figure, as of March 31st, it's staggering, 30.61.
30.61. What does that even mean in practical terms?
It means for every single dollar of shareholder value on the books, there are over $30 owed to creditors who get paid first. It's just exceptionally high leverage, puts the company on really shaky ground.
Okay, so massive leverage. And how does that debt stack up against, their actual sales?
Well, if you compare the debt to their expected revenue for fiscal 25, which is estimated around $756 million, the debt-to-revenue ratio is roughly 8.3 times.
8 times revenue, that sounds really high.
It is. It's in territory where just servicing that debt, paying the interest, becomes a monumental task, especially when you look at their profitability or lack thereof.
Which is the next big problem, right? They're not making money.
Not nearly enough to handle this debt. Their interest coverage ratio, it's negative.
Yeah.
Minus 1.51.
Negative, meaning?
Meaning their operating earnings aren't even enough to cover the interest payments they owe. That's a huge flashing red flag right there.
And the latest results? Q3 of fiscal 25. They underline that.
They do. Revenue was $185 million, okay? But the adjusted loss was 72 cents per share. And look at the gross margin, non-GAAP. Just 2.2%.
2.2. So even the stuff they are selling isn't making much profit.
Very little after production costs. And crucially, they're burning through cash.
The cash burn. How bad is it?
Free cash flow for that quarter was negative $168 million. Sources estimate they're burning maybe $600 million a quarter.
$600 million.
Or potentially $800 million over a full year, with only $1.3 billion in cash.
That doesn't last long at all.
Not at that rate. Maybe 2 quarters, 3 if they're lucky, or the burn slows. And that's before even thinking about paying back the actual debt principal.
This whole grim picture.
Yeah.
It led to something major happening in May, right? The auditor's warning.
Yes, the going concern warning. That likely just poured fuel on the fire.
For people listening who aren't familiar, what exactly is a going concern warning?
It's basically the independent auditor raising a huge flag. They're stating officially that they have substantial doubt about the company's ability to keep operating for the next 12 months.
So, not saying they will fail, but
saying, look, based on the financials, we're seriously worried they can't meet their obligations and stay in business.
And the reasons for Wolfspeed. Just everything we've been talking about.
Pretty much. The massive debt, the ongoing losses, the cash burn rate, and significantly, the real trouble they're having trying to refinance their upcoming debt payments. The company acknowledges these risks in their own filings, too.
What's the immediate impact when that kind of warning hits?
Well, confidence evaporates, obviously, the stock tanks, which we saw. But critically, it makes getting new money or refinancing existing debt incredibly hard and way more expensive.
Because lenders get nervous.
Extremely nervous.
Right.
Why lend money or cut a deal when the official auditor is questioning if the company will even be around in a year? It creates this negative feedback loop.
And you think this warning was a real tipping point, pushing things towards these bankruptcy reports?
It almost certainly accelerated things. A public warning like that can trigger loan covenants or just force management's hand. The timing, with the bankruptcy news breaking shortly after, it's hard to see it as a coincidence.
Which brings us right to that word. Bankruptcy. The reports are pretty direct.
Yeah, multiple sources, big outlets reporting that Wolfspeed is actively preparing for a Chapter 11 bankruptcy filing.
And the timeline mentioned.
It's startling, potentially within weeks.
Within weeks. Wow. Okay, for you listening, maybe holding Wolfspeed common stock, what does Chapter 11 usually mean for shareholders like you?
This is the really tough part for equity holders. In Chapter 11, common stockholders are dead last in line to get anything back.
Who gets paid first?
Secured creditors, like banks with specific collateral, then unsecured creditors, then maybe preferred shareholders, if any, by the time you get down to common equity.
There's usually nothing left.
Almost always, yes. Your shares are highly likely to be wiped out, canceled. The company's stock gets delisted. If you get anything, it's typically pennies on the dollar, maybe nothing at all.
And the market reaction showed that understanding, right? The huge stock drop.
Absolutely. Plunges of 57%, even 70% reported right after the news hit. All-time lows. The market priced in a very high probability of equity getting wiped out.
So here's a question then. If bankruptcy seems likely, and equity is probably worthless, why is the stock still trading at, $1 or $2, not zero?
That's a great question. It shows how markets work with distressed companies. It's often less about fundamentals at this point. You've got pure speculation happening.
People betting on a miracle.
Pretty much. Betting on a last-minute rescue, some incredibly rare restructuring deal that gives equity something, maybe trying to trade the volatility itself. Some might hope for tiny residual asset value, or maybe information just hasn't fully sunk in for everyone. It becomes more like a casino chip for some traders than an investment.
The reports also mention something called a prepackaged Chapter 11. What's that about?
A pre-pack is basically where the company hammers out the main points of the reorganization plan with its key creditors before filing for bankruptcy.
So they walk into court with a deal already agreed upon.
Essentially, yes. The reports suggest Wolfspeed is trying to do this, maybe already has support from a majority of creditors.
And the benefit of that approach.
It's generally faster and cheaper than a traditional Chapter 11 where all the messy negotiations happen after filing. It provides more certainty about the outcome.
But for current shareholders.
Usually the same outcome, unfortunately. The pre-negotiated plan almost always involves canceling the old equity or diluting it massively as the creditors swap their debt for ownership of the new reorganized company.
Okay, let's talk about those creditors. Apollo Global Management seems like a really key player here. They hold $1.5 billion in senior secured loans.
Apollo is arguably the most important financial player right now. As senior secured lenders, they're first in line for repayment.
So they have a lot of leverage.
Huge leverage. They have approval rights over financing, and reports say they've already shot down previous attempts at out-of-court restructuring deals.
What does that tell you?
It suggests they're playing hardball, positioning themselves strategically. They even hired their own advisor, Moelis & Company, which is typical when major creditors prepare for a bankruptcy or restructuring fight.
So what's their likely endgame?
Protecting their senior position is priority one. But beyond that, they might be aiming to use their large debt claim to gain a controlling equity stake in the company after it reorganizes through Chapter 11.
Taking ownership, essentially.
That's a very possible outcome. Their reported blocking of other deals, like maybe letting Renesas convert debt to equity, seems to point towards them wanting control over the process and the final structure.
Let's talk about Renesas. They're a huge customer, right? And also a creditor.
Absolutely. Renesas isn't just any customer. They have a $2 billion long-term supply agreement with Wolfspeed and made a big upfront payment.
So they're exposed in multiple ways.
Big time. If Wolfspeed collapses or can't deliver, Renesas loses that critical site supply, and they likely lose that big investment they made up front.
And they were apparently willing to help with an out-of-court deal.
Reports suggest they were open to converting some debt to equity, maybe to help stabilize Wolfspeed and protect their supply, but that idea was allegedly blocked, reportedly, by Apollo.
Puts Renesas in a tough spot.
Very tough. They might be scrambling now to find alternative Sykesy suppliers.
Okay, so the bankruptcy picture seems pretty clear and uh, potentially imminent. But are there any ways Wolfspeed could still pull out of this dive? Any paths to avoid bankruptcy?
That's the multi-billion-dollar question, isn't it? The paths are incredibly narrow, very, very difficult, but, theoretically they exist.
One is obviously trying to fix the debt mess outside of court, financial restructuring.
Right. They've been talking to lenders, Apollo, Renesas, exploring options for those convertible notes. But, like we said, previous attempts reportedly failed. Apollo holds a lot of the cards.
And there's a specific deadline looming, isn't there?
Yes, that's a major pressure point. There's $575 million balloon payment due on some convertible notes in May 2026. They have to figure out how to refinance that, plus other notes due later in the decade.
And refinancing that specific debt is critical for another reason.
Exactly, because successfully refinancing it is a key condition for unlocking potentially huge government funding under the CHEAP Act.
Ah, yes, the GPS Act money. That sounded like a potential lifeline.
It could be significant. There's a conditional agreement for up to $750 million in direct grants. Plus, they expect maybe $1 billion in tax credits and refunds eventually. It's meant to boost U.S. manufacturing.
But here's that catch-22 you mentioned earlier.
Precisely. It's a brutal situation. The $750 million grant the money that could really help is contingent on them successfully refinancing the very debt that's causing the distress in the first place.
So the distress prevents them from getting the money that could ease the distress.
It's a vicious cycle. Makes it incredibly hard to access that support when they arguably need it most.
Have they received any government money recently?
They did get some cash tax refunds, about $192 million in Q3 fiscal 25, and they expect more. Maybe $600 million in fiscal 26.
Is that enough?
It helps liquidity, sure, but it's likely not enough on its own and maybe not timely enough to solve the immediate multi-billion-dollar debt crisis.
Okay, beyond finance, what about their actual assets, the technology, the factories?
That's the other potential pillar for survival. Their core strategic asset, the real jewel, is that massive new Mohawk Valley 200mm silicon carbide fab in New York.
The world's largest, right?
Supposedly, yes. The most advanced 200mm CC fab. That, plus their Siler City materials plant, is the heart of their strategy.
And the strategy is basically betting everything on switching to that bigger 200mm wafer size.
Exactly. It's a high-stakes wager. Moving to 200mm is key for getting economies of scale, lowering cost per chip, and meeting the huge expected demand for SiC, especially from EVs.
Is Mohawk Valley making money yet?
It's contributing revenue, yes. $78 million in Q3 and growing, but it needs to ramp up production volume and efficiency much, much faster.
They were also trying to sell an older facility, Farmers Branch.
Yeah, that's been on the market. Selling assets is a standard move for cash-strapped companies, but reports say it hasn't sold yet. Another sign of how tough it is to raise cash right now.
And speaking of signs of crisis,
Yeah.
the big leadership changes recently. New CEO, new COO, new board members.
Definitely another major signal. In May 2025, new CEO Robert Furl, new COO Dr. David Emerson. And crucially, 2 new board members, Paul Walsh and Mark Jensen, brought on specifically for their restructuring and finance expertise.
So they're building a crisis management team.
That's exactly what it looks like. They're gearing up for a potential major financial overhaul and a huge operational pivot, whether that's in or out of bankruptcy court.
There was also that interesting report about the new CEO's internal message on bankruptcy, kind of conflicting with the official line.
Yeah, that was notable. Reports said that while the company officially acknowledges restructuring possibilities due to the debt, an internal message, supposedly from the CEO, told employees something like, no bankruptcy whatsoever with $1.3 billion in cash.
Which seems overly optimistic given the debt level.
It's a very delicate balancing act. You need to keep employees motivated, especially key technical staff for that Mohawk Valley ramp-up. But that kind of message, especially the math, $1 3B cash versus $6 plus debt, risks clashing with reality and potentially damaging credibility if things go south. It's a tough communication challenge.
Any notable insider stock moves?
Well, the CFO had a pre-planned automatic sale, which is normal. Most other activity seems to be shares acquired through grants or vesting, not big open market buys. Some interpret the lack of recent large insider buys as maybe a lack of strong conviction, but they could also be restricted from trading during sensitive periods.
What about other escape routes? Could someone just buy the whole company? A buyout?
Theoretically, yes. The technology is valuable, Mohawk Valley is a unique asset, it's strategically important for the U.S., and the stock price is crushed. So, maybe.
But the debt.
That's the huge stumbling block. Any buyer has to deal with that $6+ billion debt pile. We haven't seen any solid rumors of a buyer stepping up yet.
Could they sell just the good parts, like Mohawk Valley?
That's also possible, maybe even more likely. An asset sale, perhaps through a bankruptcy process like a Section 363 sale, could let a buyer grab the valuable fab without taking on all the legacy debt.
And circling back, that prepackaged bankruptcy still sounds like the most talked about path if restructuring happens.
It's the scenario getting the most attention in recent reports as being actively prepared, faster, more structured, but again, usually spells the end for existing common equity holders.
So pulling this all together, how's the market digesting this? What's the sentiment?
It's extremely negative, extremely polarized. Look at the short interest.
Yeah, the numbers are huge.
Huge. Reports range from 38%, 45%, even up to 64% of the available shares being shorted. That's a massive bet by sophisticated investors that the price is going lower.
But that also sets up the potential for a short squeeze, right?
Absolutely. That's the speculative angle. Any hint of good news, any rumor, could force shorts to cover, potentially driving the price up rapidly, even temporarily. Adds incredible volatility.
And a lot of trading is happening off exchange, in dark pools.
Yeah, that often happens with volatile stocks like this, where big institutions or high-frequency traders are active trying to manage their large orders.
Wall Street analysts are clearly worried too.
Oh, definitely. Multiple downgrades. JP Morgan, Citi slashed their price target to just $3.
$30.
Yeah. And maybe most telling, Goldman Sachs just suspended coverage altogether after the going concern warning. That signals deep uncertainty.
The options market saw activity too.
Right before the bankruptcy news hit the Wall Street Journal, there was apparently a big spike in people buying put options, betting the stock would fall to $3 by July. Seems like some traders anticipated bad news.
It really sounds like a falling knife situation. Very risky.
That's how many see it, yeah. Fundamentals are overshadowed by the immediate crisis, making it more of a speculative play than a traditional investment right now.
What about the retail investors? The online communities, how are they reacting?
You see a huge surge in discussion on places like StockTwits, Reddit. It's a wild mix. A lot of hope for a meme stock-style short squeeze to save the day.
The diamond hands phenomenon.
Exactly. That kind of talk, hold on no matter what. Versus others who are clearly panicking. There's also frustration with the company, sometimes conspiracy theories blaming the media.
Are they comparing it to other turnaround stories?
Yeah, you see comparisons to companies like Carvana, which also got a going concern notice and eventually recovered somewhat after restructuring. It provides a hopeful narrative, but...
But every situation is different.
Exactly. Wolfspeed's debt, its industry, its specific challenges, they're unique. You can't just assume the same outcome.
And the bigger institutions, are they sticking around?
It's mixed. Jana Partners, the activist fund that was involved before, they got out completely in Q1. That's a significant vote of no confidence.
But not everyone is running.
No. Overall, institutional ownership dipped slightly, but you still have giants like BlackRock who actually increased their stake recently. So, views differ. Some might be index funds, some might be making very long-term bets on the core tech surviving somehow.
Okay, let's refocus on the actual business strategy. Amidst all this chaos, what are they trying to do operationally?
It's all about pivoting to that 200mm production at Mohawk Valley. Everything hinges on that. It means shutting down older, less efficient 150mm lines like in Durham and Farmers Branch.
Consolidating everything onto the new platform.
Right, and that comes with painful cuts to save cash.
Like the job cuts.
Yeah, big ones. 25% workforce reduction, 30% cut in senior leadership. They also put the brakes on building that fab in Germany. All this results in huge restructuring charges, hundreds of millions this year.
What are the goals of this painful pivot? What are they aiming for?
The targets mentioned are reaching EBITDA break-even around $800 million in revenue and getting to $200 million in positive unlevered operating cash flow by fiscal year 2026. The new COO is apparently laser-focused on accelerating Mohawk Valley to hit those goals, but it really is a bet the company strategy on making that 200mm transition work and work fast. The upside is clear. 80% more chips per wafer, potentially much lower costs, but the execution risk is massive.
And fast is the operative word, given the cash situation.
Absolutely. Time is the enemy. That $1.3 billion cash pile against a $600 million quarterly burn, the runway is incredibly short, just a couple of quarters before they hit a wall without more funding or a dramatic turnaround. Those fiscal 26 targets seem miles away when bankruptcy might be weeks away. The 200mm ramp needs to be near perfect and immediate.
Okay, Let's try to summarize the opposing views here. The bull case, why might someone be optimistic despite all this?
Fundamentally, it rests on Wolfspeed's technology. Sources consistently say their sex, tech, and materials are top tier, second to none. They have that unique, massive Mohawk Valley 200mm fab, a huge strategic asset, especially for U.S. manufacturing.
And the market itself is growing.
Exploding, potentially. Success is crucial for EVs, AI data centers, industrial power, defense. Analysts project huge growth, like 34.5% CAGR through 2034.
So the argument is, great tech, unique asset, massive growing market, if they can just survive the storm.
That's the core of it. Plus, the potential for CHIPS Act money eventually, the national security angle may be prompting some kind of support, and that ever-present possibility of a massive short squeeze. Bulls argue the current price ignores this long-term potential if they navigate the crisis.
And the bear case, the reasons for pessimism.
Equally strong. Starts with the crushing financials we detailed. Debt, cash burn, negative coverage, the auditor's warning. Operationally, the threats are fierce competition, especially from China.
The China syndrome mentioned in the notes.
Right. Aggressive pricing, taking market share, squeezing Wolfspeed's margins, that makes the turnaround even harder.
And the massive risk in just making the 200mm transition work.
Huge execution risk. Ramping up a new, complex, cutting-edge fab is notoriously difficult. Delays, yield problems, cost overruns. Any slip-up could be fatal given the short cash runway. Add potential market headwinds like slowing EV growth in some areas. The bear case says the hole is too deep, competition too strong, execution hurdles too high. They might just run out of time and money.
Execution is everything, and the clock is ticking loud.
Extremely loud.
Wow. Okay. Clearly, Wolfspeed is at an absolutely critical juncture.
They really are. Facing a severe financial crisis, massive debt, burning cash fast, that formal auditor's warning, leading to these very credible reports of likely imminent bankruptcy.
And for current common stockholders, the outcome in that scenario looks pretty bleak. Equity likely wiped out or severely diluted.
That is, unfortunately, the typical path in these situations.
The escape routes seem incredibly narrow.
Extremely narrow and steep. Needs a successful out-of-court debt deal, which hasn't happened yet, complicated by creditor positions like Apollo's. Needs that SHIP-PS Act funding, but that's stuck in the catch-22, and needs flawless, rapid execution on the 200mm pivot at Mohawk Valley to generate cash way faster than expected.
The new leadership team certainly seems handpicked for this kind of challenge.
Their background strongly suggests a focus on navigating exactly this kind of intense operational and financial crisis.
And the market is just wrestling with this huge uncertainty, the massive short interest, the retail hope, the split institutional views.
It really highlights the binary nature of the situation right now.
Either they somehow pull off this incredibly tough turnaround and financial rescue outside of court.
Or they face a financial reorganization.
Most likely via Chapter 11, possibly that prepackaged route, which again is usually bad news for existing equity.
That seems to be the most probable path according to recent reports.
So here's a final thought for you, the listener, to chew on. With such a short cash runway and these immense financial and operational mountains to climb, can Wolfspeed's big strategic bet on 200mm deliver fast enough to outrun its crushing debt? Or is a financial restructuring, probably bankruptcy, the most likely outcome, completely reshaping the company and the value of current investments?
A huge amount hinges on what happens in the coming weeks and months. It's going to be critical to watch.
It certainly is. Well, thank you for joining us for this deep dive into Wolfspeed's challenges and the very difficult road ahead.
Yeah, we hope this gave you a clearer picture based on the reports out there. It's a fast-moving situation, so definitely keep an eye on it.
Absolutely. Hopefully this serves as a good starting point for your own thinking and research.
Thanks for listening, everyone. And hey, if you found this useful, please do like, subscribe, and hit that notification bell so you don't miss our future deep dives.
We'll see you next time.